Good morning, everyone. Thank you for joining us, the Phillip Security Morning Call. I'm Zi, Fixed Income Analyst at Phillip Security. Today, we will be covering a few sector and macro updates, including Singapore Banking Monthly, Max 7 Monthly, Singapore REIT Monthly, along with our weekly markets highlight. Other stock counter updates, we have results and updates from several key names, including JP Wells Fargo, Bank of America, Netflix, Oracle, FCT, Keppel DC REIT. For Phillips on the ground, we have TSMC, ASML Holdings. We also have S&P 500 technical analysis for S&P 500 today. Disclaimer. Alright, here is our disclaimer page. The information shared today is for educational purpose only and should not be considered financial advice. Please consult financial advisor before making any investment decisions. So without further ado, I will now hand the time over to Glenn. Thank you.
Hey, thanks, Zi. So we'll be going through JP Morgan first. So for JP Morgan, they released their third quarter results. Actually, all of the banks the US banks that we cover released their third quarter results. So for JP Morgan, their earnings did rise by 12% year-on-year to 14.4 billion, but it still came below our estimates. Mainly because the provisions the increase as well, and also net interest income was lower than expected. So net interest income inched up by 2% from higher markets net interest income, and also from loans growth of 7%. The non-interest income has continued to be the growth driver for JP Morgan, and the growth came from principal transactions, mainly from fixed income as well as the equity markets, amid elevated levels of volatility, and also asset management fees, which grew by 14% from growth in management fees due to the strong net inflows and the higher market average levels, and also investment banking fees from higher fees across all products. So look at the total non-interest income, it grew by 17%, and it has contributed to 48% to total net revenue. As for loans growth, it has continued to support the net interest income. So net interest income was the net interest margin was actually down slightly because of the decline in funding costs was faster than the decline in asset yields. So this resulted in the net interest spread actually rising slightly to 1.92%. But loans growth did help to support the net interest income, and it came from credit card as well as wholesale. So the main negative is that the provisions have come back up. So the provisions were driven by higher net charge-offs, which came from both the wholesale as well as the card services. As for the outlook, they have continued to raise their guidance, but slightly only. So they have risen their FY25 guidance and net interest guidance by 300 million, from 95.5 to 95.8 billion. And the increase will really come from balance sheet growth and mix, offset by the impact of lower rates. And on the expenses side, it has also been increased from 95.5 billion to 95.9 billion, driven by the stronger revenue environment, which would grow their OPEX as well. And but the good news is that they have lowered their guidance for the card services net charge-off rate from 3.6 to 3.3%, mainly from favorable delinquency trends driven by the continued resilience of their consumers. As for the 2026 guidance, they have only provided preliminary guidance of for NII excluding markets of around 95 billion. So this is higher than what was previously. This will be around a growth of a few percentage points. A few percent. So we do maintain neutral, but with a higher target price of $305. We lower the FY25 earnings by 10% as we adjust other income as well as OPEX estimates, and also increase the net interest income slightly and the provisions estimates. But the reason why we have a higher target price is because we lowered the beta to 1.1 from 1.4 to better reflect the JPM's position. We like JPM for its ability to continue growing revenue in all of their segments. But then again, despite them raising their guidance, we are cautious due to headwinds coming from macro uncertainties, such as the trade tensions as well as policy shifts, which would increase provisions and NPLs, and interest rate cuts, which could hurt their net interest income and lower margin expectations. And also, more importantly, their valuations are quite full, with their PE ratio at 15 times, which is quite a bit higher than the 10-year average of 11.6, and also their PB ratio, which is at 2.5 times. So this is higher than the 10-year average of 1.5 times. Now moving on to the next slide, we'll be looking at Wells Fargo. Yeah. So for Wells Fargo, the key highlight is that, as the title suggests, is that the medium-term target has been revised upwards. In terms of their third quarter earnings, it was quite positive. It grew by 9% year on year, but it came in slightly below our estimates. So the net interest income rose by 2%, also inched up, similar to JP Morgan, driven by the fixed rate asset repricing as well as better markets business. Non-interest income has continued to grow, and it was supported by the card fees, investment advisory and brokerage commissions, investment banking fees, which came from higher debt, capital markets advisory, and equity underwriting fees. The non-interest income rose by 9% year on year in the third quarter, and contributed 44% to total revenue. The other positive that also boosted their earnings was the provisions have fallen by 36%, really from net charge-offs decline, driven by lower credit card and residential mortgage net loan charge-offs. So as I mentioned earlier about the net interest income, it has inched up, also rose from average loans, which grew by 2% year on year. The main negative is that the expenses has risen. So the non-interest expense rose by 6% year on year, from an increase in both personnel and non-personnel expense, and also came mainly from their severance expense, which they were trying to cut some headcount, and I guess this severance expense will increase in the short term. As for the outlook, they have maintained their guidance for 2025 and expect it to be roughly in line with FY24 for net interest income, but they have increased their expense guidance slightly from 54.2 to 54.6. The medium-term target has been raised for Wells Fargo. So the main reason for this is because the $1.9 trillion asset cap that they were hit with was removed just recently in 2025, a few months ago. And because of this, their total assets have surpassed $2 trillion for the first time, and they also enabled them to grow their trade-related assets by 50% since 2023. So as such, now they are targeting a medium-term ROE of 17 to 18%. Previously, it was 15%, and also a CET1 of 10 to 10.5%. Currently, it's around 11%. We maintain accumulate with a higher target price of $95. We also lowered the beta to 1.2 from 1.4 to better reflect the Wells Fargo's profile after the removal of its asset cap. And we expect the lifting of this asset cap will allow the bank to grow deposits, expand lending, and also invest in markets and trading, and strengthening its balance sheet, flexibility, and competitive position. But then again, we also do see some headwind will be coming from the macroeconomic factors, which could impact their non-interest income growth. So that's for Wells Fargo. Let's move to the last bank, which is Bank of America. So Bank of America was, had the strongest growth amongst all three banks. Their earnings rose by 23% year on year to 8.5 billion, and it was above our estimates. They recorded growth across all segments. Even their provisions also improved. The net interest income has risen by 9%, which is the highest amongst the three banks, and they have mainly from the increased global markets activity, fixed rate asset repricing, and the growth of 9%. The non-interest income has continued to support earnings momentum. So the asset management fees has continued to grow really from higher market valuations and strong AUM flows. The provisions have also fallen from lower net charge-offs, as both the consumer and the commercial net charge-offs have fallen. So for the outlook, they have maintained their guidance, and they have said that the net interest income will grow by around 6 to 7% in FY25. So if you look at it, since the third quarter results are out, for fourth quarter, we expect net interest income to grow by around 8%. And this will come from the continued fixed rate asset repricing, as well as the fixed rate securities, loans, and swaps roll off and are repriced at higher rates. For expenses, it's expected to grow more slowly. Their guidance for fourth quarter is that it will be in line with the third quarter, So we see that this will mean around a 4% growth in FY25 expenses. So we maintain and accumulate with a higher target price of $56. We raised our FY25 estimates by 9% from higher fees and commissions as well as lower provisions estimates. We expect that the growth drivers for Bank of America will come from higher net interest income from the fixed asset repricing and loan growth, continued growth in their wealth management fees due to higher capital markets activity, and a higher global markets revenue from the heightened volatility and also slower pace of expense growth. Yeah, so that's all for Bank of America. Now let's move on to the banking monthly. Yeah, next slide, please. Thanks. Yeah, so for banking monthly, we will start firstly with the interest rates. So interest rates, the 3-month SORA has continued to decline. It fell by 21 basis points here, month-on-month to 1.51%. This is the lowest that we have seen it since August of 2022. And this surge in capital inflows, as Singapore remains the safe haven, has caused a steep decline in the interest rates and also a continued decline in interest rates. And furthermore, to pile that on, there's also the rate cuts that are coming in, and we expect that the 3-month SORA will continue to decline further. And so the Hong Kong interest rates, the HIBOR, has continued to recover. It rose by 102 basis points month-on-month to 3.32%. The next slide, please. We're looking at the loans growth. So for loans growth, the Singapore loans growth has remained above 6% continuously. So this is 3 consecutive months that it has been above 6%. And it came from both the business and the consumer loans. The year-to-date loans were up by 5.5%, and we expect that this will maintain at these levels, driven by the further recovery from the rapid decline in Singapore interest rates, and also the additional rate cuts that are anticipated for the rest of the year. And the banks are also still guiding, at least based on the second quarter, low to mid-single-digit loans growth. We expect them to at least adjust this slightly, I think, when we have their third quarter results released in the first 2 weeks of this November. So business loans have grown from the building and construction, mainly from the manufacturing segment, and the consumer loans are quite stable, as the housing loans are also quite stable at 5%. Moving on to the next slide, we'll be looking at the deposits and balances. Yeah, so total deposits and balances have grown by 9% year-on-year, and more importantly, the current account and savings account, or CASA ratio, has risen to 19.4% from 19.1%, and it has also grown by 15% year-on-year. So this is a very important figure for the banks, because this represents the cost of funds for the banks, and we expect that the CASA ratio will continue to rise as the higher interest fixed deposits mature, and also with the low interest rates, a lot of these funds are shifted back and placed and held back into their current account or savings account. Now moving to the next slide, we're looking at the SGX statistics. So in September, the SGX volumes, the SDAV and the DDAV have moderated quite a bit. SDAV only grew by 5% year-on-year, while the DDAV actually declined slightly by 3%. As for the top 4 equity index futures turnover, it rose by 3% year-on-year, mainly due to the increase in the FTSE China A50. Now moving on to the next slide, we're looking at the Singapore Bank's performance in September. There's a slight typo here. Yeah, so the share price performance of the 3 local banks dipped slightly in September with a decline of 1%, because the increase from DBS of 2% was offset by declines by both OCBC and UOB, which also fell by 2%. So the reason for the continued strength in DBS was really due to their clearer dividend policy and guidance that they have provided, which is a lot more clearer than the other 2 banks. Now moving on to the next slide, so we'll just be concluding. We maintain neutral, and we believe that the continued decline in the Singapore and Hong Kong interest rates, the bank's NIMs will also see a similar decrease, which will affect both the net interest income and earnings. But despite these rate cuts, it will actually benefit their funding costs, as we have seen the CASA ratio continue to improve, and this will help to ease the NIM compression and also the loans growth from the lower interest rates will also help net interest income. And the bank's dividend yields of 6.1% remain attractive as the capital return initiatives are expected to continue for the rest of the year and possibly into the next 2 years as well. So that's all I have for the banks. I'll now hand it over to Helena for Netflix. Thank you.
Thank you, Glenn. So I'll continue with Netflix. So Netflix, they're seeing some margin pressure. So overall, the third quarter revenue was in line with expectation. Their PMI missed because they have a $619 million dispute with the Brazilian tax authorities. So if we were to exclude this effect, their 9 months revenue and PMI were at 73 and 83%, which is in line with our FY25 estimate. So revenue overall grew 17% year on year. This is largely driven by membership growth, pricing adjustment, and increased ad revenue. Moving on to the positive point, they have very strong content lineup, so that is why it's fueling the subscription growth. They no longer disclose the exact number for the subscriber, but they did mention that the growth has been really robust. The addition was driven by a lot of nice content coming in, including the hit series like Wednesday, Alice in Borderland, and also feature films like K-pop Demon Hunters. They also have high profile live events such as the champion bout between Terrence and Canelo. So looking ahead for the next quarter, they still have a lot of exciting content coming up. They have upcoming titles like Stranger Things, Frankenstein, and the NFL Christmas Game Day special. So all of these are expected to sustain their momentum into the next quarter. The revenue actually accelerated. It was 17% year on year. That's the fastest pace in nearly 4 years, and this is in line with their guidance. And the second strong point is they're seeing very strong growth in advertisement. So this is a sector that they've been focusing a lot in the past few quarters, has been scaling rapidly. It has delivered its strongest ad sales quarter on record. And a key driver for ad revenue is actually viewing engagement. In the last quarter, they were actually a little bit uncertain. They indicated that engagement growth was pretty flat, but this quarter, the sentiment turned to a more optimistic note. They're saying that viewing engagement has been rising steadily. They've also quoted Nielsen and Barb data saying that the TV view share in both US and UK is actually a record share. And the US grew by 15%, UK grew by 22% since FY22 to now. And in order to further boost engagement, they are now planning to partnership with Spotify to bring video podcasts to Netflix members. And also they're trying to launch interactive ads later in the quarter. So with all these initiatives, Netflix will remain nicely on track to more than doubling its advertising revenue in FY25. Moving on to the negative, like I just mentioned briefly, their margin faces pressure. Sorry, okay, move back. Yeah, so Netflix reported a 1.4% contraction in their operating margin, which came in 3.3% lower below guidance. So this is because of the additional expenses related to the Brazilian tax dispute. But even if we exclude that impact, their operating margin would be 33.6%, which if you compare it with last quarter, it's still considered slightly below. So this is because they're increasingly spending a lot in order to sustain its growth momentum. Their sales and marketing expense rose 22% year on year, which is the fastest increase in the last 4 years. Also, their technology investment was increasing like 16%. That's still a very notable acceleration compared to the last year. So they really, if they want to preserve their margin strength, given the speed that they're spending, they will really need to increase their pricing again. So management did guide it for operating margin of 23.9% for the next quarter. So that's a 1.7% improvement compared to last year. So our outlook-wise, the next quarter guidance, if guided 17% year on year, increasing revenue, operating margin I just mentioned, and looking forward to FY25 as a whole, they expect revenue growth to be 16%, but they guided the operating margin down to 29% because of this Brazilian tax impact. So we think the overall narrative for Netflix remain consistent. It holds a dominant position in the streaming market. It's supported by very strong earnings momentum. The company continues to outperform its closest rival, Disney. They are more than nearly double the average revenue per member, and they have a much larger subscriber base, even though they don't disclose it anymore. And now they're trying to expand into advertising business, so we've seen that being highly successful as well. And they also have very limited exposure to tariff. But however, the valuation right now appears very stretched even after the share price went down. So they're still trading at 39x forward PE, which is well above the industry average of 17x. So we still remain a very cautious view. Our valuation remained unchanged with a DCF target price of $950. So that's all from me. I'll pass my time to the US team.
Thanks, Helena. Yeah, I'll be presenting on starting out with Mac 7. Yeah, so for Mac 7 September performance, it outperformed the S&P 500 and Nasdaq. It increased by 7%, and this is driven by Tesla as well as Google. So for Tesla, it is the biggest gainer among the Mac 7 because it released very positive third quarter deliveries, which is the highest in 7 quarters. And this is also because the EV tax credit is coming to an end. So they may see some pull in terms of people rushing to buy the EVs before the expiry of the tax credit. And Google is the second biggest gainer also because the US judge ruled that Google does not have to divest Chrome as well as Android. That's why this removes the major overhang of the regulatory risk. For Amazon, it is the biggest laggard among the Mac 7 because tariff concerns will weigh down on their e-commerce margins. So among the Mac 7 is the biggest laggard. And overall, Mac 7's performance in September was supported by lower interest rates because the Fed lowered their interest rates. So this increases the kind of equity valuations for the growth-driven Mac 7. And because there is also a greater demand for sovereign AI, which I will elaborate more in the next few slides. I'll hand over the time for now to Glenn. Thanks.
Thanks, Ivan. Yeah, so I'll just be doing Tesla. So Tesla, we maintain our sell call with a target price of $222. So, just the positives firstly. The highest quarterly deliveries growth in 7 quarters for the third quarter, really from the removal of the $7,500 EV tax credit, which kicked in 30th September 2025. So this was removed on just nice, at the end of the third quarter. So we saw a mad rush, I guess, from consumers to purchase an EV car, right? To get this $7,500 benefit from the government, the US government. And we believe the majority of the increase in deliveries that they had from the third quarter came from the US. So they don't really give a breakdown of which segment grew the fastest. But yeah, so we believe that this really came from the US because of this EV tax credit. However, and also because if you look at the September sales figures, China and Europe have continued to decline, right? They have continued to lose market share in these, and basically almost all the other countries that is not US. So Germany, China, the rest of Europe all has declined. And the main reason why the share price has improved so much is because they have bought back, Elon Musk bought back $1 billion of Tesla shares. And if you look at it in the greater thing of things, it's not that much, right? It's $1 billion is a lot of money, but if you see the number of shares, it's about 2.57 million. And you look at the shares that he owns, is around 400 million. So it's only less than 1% of his current ownership. So this won't really change much, right? It won't move like the ownership numbers a lot, right? So it's just, I guess, headline news, and it did help to signal to investors, of his confidence in the growth of the company. And you also saw that the share price has risen quite a bit after he made that purchase. So we believe, that while the shares have surged, the quarterly deliveries are also quite strong. But this is just sort of until third quarter. Then after this, we expect that it will fall off. And a lot of the other initiatives that they are looking at, which is like the robo-taxi and then his Optimus robot, right? They are still very far away from, actually providing any sort of earnings growth, right? Or at least provide to earnings at all. The robo-taxi is still quite some time away, right? They only have managed to roll it out in certain areas in California, and not even a full-scale rollout yet. Their competitors like Waymo are already running it at a full scale. And also the Optimus robot is, they haven't even started to produce it yet, not yet alone, not commercially sell it yet. So these are all, I would say medium to long term kind of targets, instead of short-term targets like what Elon Musk would want everyone to think. Yeah, so that's why we have a sell call and also a target price of $220. Yeah, that's all for Tesla. I'll hand it over to Helena for Apple. Thanks.
Thanks, Glenn. So I'll move on to Apple. So Apple, obviously, they just rolled out their iPhone 17 series. So the news were mainly revolving from there. So the iPhone 17 lead time appeared to be much higher than last year. Their website and various carrier sites all showed an average of a shipping wait of around 19 days for the iPhone 17. So this is significantly longer than the 5-day wait for the iPhone 16 last year. So that kind of suggests a very robust demand for the new model. Another news that we see is the high demand is kind of prompting Apple to increase production for its entry-level iPhone 17. So Apple has asked 2 of its main iPhone assemblers in China to ramp up the daily output by 40% after receiving the higher than expected pre-orders for the iPhone 17. So all these show that the demand for iPhone 17 has exceeded expectation. So I think the likely reason for that is because they do have several meaningful features, upgrades, and because now the cheapest, it's the same entry point compared to iPhone 16. But if you think about it, it has improved features. It has double the storage size and better specs. So a lot of people think it's a good buy. But with that being said, we continue to see very limited signs for a broad upgrade cycle because this time around they didn't really roll out any AI related upgrades. So the biggest highlight that they have for their Apple Intelligence would be their Smart Siri. So that was postponed to 2026. So far we're not seeing any convincing sign that there's going to be a broad upgrade cycle soon. And also another thing that's worth considering is because of the pricing of the iPhone 17 lineup remains unchanged compared to the iPhone 16, that means Apple is actively absorbing a lot of the higher costs tied to tariff and production because now they're trying to relocate a lot of their production back to the US. So that definitely increased their cost of production. So this would likely put additional pressure on its margin. So right now we maintain a cautious outlook. We have a reduced recommendation with a target price of $200. Moving on to the next slide. Yeah, so not much update for Amazon. So Amazon and Netflix, they actually just tied up for an ad partnership. So it allows advertisers to use Amazon's DSP to access Netflix ad inventory. So this aligns with Netflix Go. Like I mentioned, Netflix is also trying to push its advertising business. So they're really giving advertisers more flexibility to meet their marketing objective. So advertising for Amazon has also been one of the fastest growing segment. It rose 23% year on year in the latest quarter. And the expanding adoption of their Amazon DSP platform, they're doing a lot of new partnership. Previously, they've done partnership with Roku, and now they're doing with Netflix. It highlights their proactive push to scale their advertising business. We see advertising as a major growth driver for Amazon because it's able to expand together with its retail operation. Right now, it's still a very, very small segment. It's only accounting for 9% of the revenue. But compared to 1 year ago, it was only 8%. If we really take a look at how it's been growing over the past 4 years, it's growing at around average CAGR of around 24%. So it's still considered pretty steady growth. So that's all I have for Amazon. I'll pass my time to Serena.
Hi, good morning, everyone. I'll present Meta and Alphabet. I'll start with Meta first. So last month, the company actually hosted the annual Meta Connect conference in order to release the new generation of AI-powered smart glasses. So firstly, there will be a Ray-Ban Meta display smart glasses, which will be sold at around $800, and it will be featuring display technology that can surface Meta AI. And Meta also launched a upgraded version of Ray-Ban smart glasses, which improve the camera quality and also extended the battery life. And it will be sold for around $380. Lastly, they also debuted the Oakley Meta Vanguard AI glasses, which is pricing at around $500. This is actually an athlete-focused model that will integrate very seamlessly with the fitness platform. Secondly, the company also follow UK's ICO regulation guidance, so that the Meta now will be running on a pay or consent subscription model for Facebook and Instagram in the UK. So the user actually will have the option to pay a monthly fee ranging between £3 to £4. So to use the platform at free basis, or they can choose that to consent to data usage so that Meta can use it for more personalized ads. So through the Meta Connect, we actually do see Meta commitment to scale the reality lab business on longer term basis, but we do not really believe that the contribution will be very significant in the short to medium term, even though even though the AR and VR market actually is growing quite significantly, but we still don't think that the revenue contribution will grow very significantly, partly because the global AI glasses adoption is still in the very early stages. So that for Meta, what we primarily will be focusing on will still be the core advertising business, which remain quite positive about the outlook. So the company will announce the quarter earnings on Wednesday this week. We do expect to see a stronger user engagement to boost the higher ad pricing. We also are interested and also do expect to see more scaling progress on Threads. This is a Meta text-based social media platform, which is very tightly integrated with Instagram. Instagram, yeah. And because the company also announced that the platform actually reached 3 billion monthly active user in September. So this is why in this earnings call, we are wondering what's the scaling process in Threads, because it could provide a very potential pipeline for their ad business. That's why for Meta, we actually have an accumulated rating with the target price of $830. Next slide, please. Thank you. So next, for Alphabet, so the company actually announced a series of very large-scale global infrastructure investment in India, in US, in Europe, and the UK. This is to enhance the AI and cloud capacity, and also the data center footprint. And the investment size is quite significant, especially in India, because Alphabet is actually planning to invest around $15 billion in a new data central hub over the next 5 years within a country. This is Alphabet's largest commitment in India, and after that, the site will be the company's largest AI hub in the world outside of the US. And within the US, Alphabet is also planning to spend approximately around $18 billion to expand the cloud and AI infrastructure capacity through 2026 and 2027. Next, the EU Commission actually imposed a 2.95 billion euro fine on Google for violating the EU antitrust rules. For those who are not familiar with the case, basically the EU Commission actually found that Alphabet actually has an abusive practice in online advertising technology business. So the Commission actually believes that the company actually intentionally gives ADX, which is this is Google's ad exchange business, a competitive edge by favoring the online display advertising technology services in the ad bidding process, because Alphabet do have dominance in the market for ad publisher, especially in the EU region. So it has ordered the company to actually stop this self-preferencing practice, and at the same time that it requires the company to address the conflict of interest within 60 days, or else they do have to face a further remedial action. So Google actually says that it disagrees with the decision and it intends to appeal it. So overall, we actually do see the continued expansion to improve AI infrastructure as a positive move for long-term competition in cloud computing and also Gen AI area. We think this investment are actually necessary because it helps to scale the AI capacity to support Google's cloud business, and also the further Gemini deployment across the ecosystem. And we also think the pace of the investment also reflects a rising enterprises demand for Google Cloud services. And also it also shows the efforts, Alphabet effort to actually integrate more Gen AI more deeply into the core search business. But at the same time, the regulatory headwind still remains a risk for Alphabet, because with the recent 2.95 billion euro fine, and also there's actually a US ongoing US edtech antitrust case that could potentially result in operation changes or structural remedies, such as a divestment of the edtech business. So in that particular case, which is in the US, is currently now in the remedies phases, but the DOJ actually proposed a divestment of Google Ad Exchange and also partial sales of DoubleClick for publisher. This is actually an ad server for website publisher. But regardless, we still remain positive on Alphabet fundamentals. The company will also announce the third quarter earnings same days at Meta. We do expect to see very resilient performance from the company. So what we expect to see especially is that we expect to see a very strong cloud deal momentum to reflect on the cloud revenue growth. And we also expect to see more increasing Gemini adoption will be reflected on the user engagement. Yeah, and that's all from me. I'll pass that time to Iqbal. Thanks very much.
Thanks, Arina. Yep, so Fahmi is on leave today, so I'll be covering on his behalf for Microsoft. So Microsoft, over the last month, they offered US government $6 billion in cloud saving because they offered the government free Copilot as well as Azure discount. So this sums up to about $6 billion for the US government. And Microsoft, NVIDIA, and Google also announced multi-billion-dollar AI investments in the UK. So total investments will sum up to about $30 billion. And this is part of the $45 billion joint push to strengthen AI leadership as well as positioning the UK as a global AI hub. And third announcement is that Microsoft OpenAI reached a non-binding deal to allow OpenAI to restructure and be more independent. So this creates some uncertainty around future GPT access for Microsoft. For Fahmi's comments, he thinks that Microsoft's $6 billion cloud savings to the US government is a strategic move because this can deepen public sector engagement as well as to challenge key cloud and AI competitors. And also the multi-billion-dollar UK AI investments highlights a long-term commitment to global leadership as well as align with geopolitical priorities. And this also shows strong sovereign AI demand from UK itself. Fahmi maintains a accumulate recommendation with an unchanged target price of $550 for Microsoft. Yeah. Next slide, please. Yeah, so for NVIDIA wise, we see strong demand from sovereign nations starting to pick up. So if you can see at the chart in the bottom right-hand corner, the blue color line shows Europe's semiconductor revenue compared to America and APAC, which is the orange and red color line. So as you can see, Europe's trailing 12-month semicon revenue declined by 1% year-on-year in August. However, this decline in 1% is the best performance since May 2024, and we are starting to see a pickup in terms of revenue. We do think that this will mirror America and APAC's semicon revenue. And this is because one development going on is NVIDIA partnered with Nscale, which is UK's AI infrastructure company. You can think of them as a smaller hyperscaler to scale up 300,000 Blackwell GPUs. So if we assume about 250K per Blackwell GPU, this gives NVIDIA a potential $75 billion revenue for the next 3 years from 2026 to 2028. So this is about a 15 to 20% kind of revenue boost annually. And NVIDIA also announced strategic deals to capture future demand. So for example, they announced a partnership with OpenAI to deploy 10 gigawatts of NVIDIA GPUs for OpenAI's AI infrastructure. And also NVIDIA will invest $100 billion in OpenAI over the next few years. And apart from OpenAI's deals, NVIDIA also announced a $5 billion equity stake in Intel. So it plans to design its RTX gaming chips into Intel's x86 system on chip. So Intel's currently has a market share of about 70% in mainstream PC. So we think that NVIDIA is also trying to break into this market. Our comments for NVIDIA is that we think that going forward, they will experience higher GPU demand from sovereign nations, as you can see currently from Europe already. For example, European Commission allocating Euro 20 billion to construct 4 AI gigafactories, as well as NVIDIA's partnership with Nscale to build out AI factories across US, Portugal, Norway, and UK. And also the deployment of about 100,000 NVIDIA chips for the Stargate project starting from next year. And this gives a potential revenue boost of about $25 billion, which is about close to 20%. So overall, we are still positive on NVIDIA. We have an accumulated call target price 185. Yeah, next slide, please. Yeah, so overall for rounding up for Max 7, we remain overweight. Their performance is being supported by US Fed lowering interest rates, which increases their equity valuations. And because there is also greater sovereign demand for AI infrastructure, especially can be seen from Microsoft committing $30 billion in UK AI infrastructure, as well as NVIDIA agreeing to scale up 300,000 GPUs in AI factories across US, Portugal, Norway, and UK. We do think that this is a positive development for Max 7. And yeah, so these are the tailwinds for Max 7, as well as US government's AI action plan, which shows a stronger commitment to developing AI infrastructure on US soil itself. Yeah, so that's all for Max 7. Next slide. Yeah, so we are doing a Phillip on the ground for TSMC. They recently released their earnings. Next slide. Yeah, so for TSMC, we don't cover them. So they released their third quarter results. For those who are unsure, they do advanced chip manufacturing. This consists of about 74% of their third quarter revenue. And their revenue is still growing on this very strong upward trajectory. Their third quarter revenue is increased by 41% year on year in US dollar terms. And this is being driven by strong demand for leading edge process technologies. Their margins also increased by 1.7% percentage points year on year because of lower cost and higher capacity utilization. But also being offset by dilution from overseas fab because they are building fabs in Arizona. So they guided an average about 3% gross margins dilution every year for the next 5 years. As for looking at their CapEx wise, their third quarter CapEx, it increased by 70% year on year. So as you can see from the chart, the blue color bars represent the actual CapEx itself, while the red color line represents the year-on-year change. So you can see over here, based on the red line itself, the CapEx cycle is about 2 to 3 years from trial to peak. So I do think that it is possible that there will be a slowdown in terms of the CapEx growth. TSMC narrowed their guidance. Previous guidance was $38 to $42 billion CapEx for 2025, so midpoint about 40 billion. So they narrow it to about 40 to 42, so midpoint about 41 billion. This 41 billion will represent a CapEx growth of 37% year on year. We do think that it will slowly, this kind of CapEx growth trend will slowly decelerate because based on the red color lines, it seems quite peakish already. However, we do think that it wouldn't decline that significantly, even if there's a decline in growth. Our outlook for TSMC is that because N2 will start scaling in fourth quarter and also begin ramping next year itself. So this will bring in TSMC continuous growth for next year itself. As for TSMC's CapEx, we do think it will likely to increase, even though at a slower pace. And they also see increasing demand from sovereign AI, as mentioned earlier. For TSMC itself, they are close to securing a second plot of land in Arizona in the US to scale up gigafab cluster for smartphone AI and high performing compute applications. And they also they are starting to construct a second fab in Kumamoto, Japan. And they have also received commitment from the European Commission as well as German government to build a fab in Germany itself. Yeah, so these are some positive developments which also confirms our outlook that there is increasing sovereign AI demand. Yeah, next slide, please. Yeah, I'll be also presenting Phillip on the ground for ASML Holding. Next slide. For ASML Holding, we also don't cover. This is their third quarter results. For those who are unsure, they are a semicon equipment manufacturer. They are the only company which manufactures EUV technology lithography machines, which stands for extreme ultraviolet machines. So these are crucial for scaling beyond the 5 nanometer chips in semicon itself. For their latest quarter revenue, it increased 0.7. I mean, it's almost flat. So this is below their guidance midpoint. And it's also much softer because their previous quarter, it was about 20% year-on-year increase. Yeah, so recent developments for ASML, the positive thing for them is that they, SK Hynix, which is a memory company, they took the delivery of their first high-NA EUV machine. So, first high-NA machine for their memory chips. So, and another development is that ASML also invested euro $1.3 billion, 11% stake in Mistral AI, which is a French LLM startup. You can think of them as similar to ChatGPT, but from France itself. Yeah, so we do think that this is a good alignment to ASML's business because they do have to see how the LLMs models are being run before they design their chip equipment itself. For their guidance for the next quarter itself, it is very soft. It is 2.2% year-on-year increase midpoint. They mentioned that for next year itself, the revenue, the statement they mentioned was that they do not expect 2026 total net sales to be below 2025. A lot of analysts took this positively. I think I'm just neutral because I think compared to its competitors, Lam Research, for example, Lam Research is still growing about 20+% year-on-year in the most recent quarter itself. But ASML hasn't been seeing this growth in the most recent quarter results itself. Yeah, as for their guidance for the high-NA EUV orders itself, they do think it will start coming in second half of next year, and shipments will begin 2028 and beyond. So for ASML itself, I think it is a long-term play, about 2 to 3 years beyond. And they also expect China net sales to decline significantly from next year itself because of the cycle. Because China experienced quite strong orders over the past 2 years. As for so if you look at the revenue breakdown for their on the chart on the bottom right-hand corner, so the DUV sales, which is being represented by the R5, the blue color region, it increased. So this offset the drop in EUV sales, which is being represented by the orange portion. So we do think that this drop in EUV sales is because TSMC has been didn't buy as much EUV machines in their most recent capex itself. Even though TSMC's capex grew, but they did not order as much EUV machines from ASML. Yeah, but however, we do think that as you can see in the chart at the bottom left-hand corner, we do think that there is a spike. This spike in memory bookings from companies like SK Hynix will be able to offset this softness in terms of EUV orders. Yeah, so that's our outlook for ASML. Yeah, that's all. I think there's almost slide for Fahmi on Oracle. So Fahmi did an update because Oracle presented at the Oracle AI World Conference. So first of all, they unveiled some new technology as well as capabilities. For example, they unveiled this technology called Accelerant, which is a network infrastructure to deliver faster throughput as well as lower costs across workloads. However, the details are not being released. Secondly, Oracle has also booked several new deals with 4 major clients. So this brings their remaining performance obligations above $500 billion. So you can think of this as like their order book. So these 500 billions will last for the next 5 years. So this brings them some order visibility. And they also have some management changes. For their FY30 guidance itself, they increased their Oracle Cloud Infrastructure revenue guidance to 166 billion by FY30. This is an increase of about 15% from previously they guided $144 billion. So this is also driven by AI-powered cloud growth. For Fahmi's recommendation, still maintained by with an unchanged target price of $350. And he remains bullish on Oracle as a niche Oracle Cloud Infrastructure provider, as well as full stack AI provider with a significant RPO backlog. Yeah, so that's all from my end. I'll hand over the time to Darren. Thanks.
Yeah, thanks, Ivan. Yeah, I'll run through FCT's full year 2025 results. So we're expecting continued positive rental reversions after the past 2 years saw about 7% positive rent reversion. Yeah, so for the results, full year as well as the second half 2025 was in line with our estimates. So you see the 14% jump in gross revenue. That was because of the 4-month plus contribution from North Point City South Wing, which completed its acquisition in May, and as well as from almost a full year contribution from Tampines 1 upon its completion of the AEI. Yeah, so as a result, DPU was up 0.6%. Some of it was also due to a lower cost of debt as well. Yeah, so for the positives, the occupancy cost for FCT, which is basically rents divided by tenant sales, still remains below historical averages of 16.1%. So the pre-COVID was trading about 17%. So this is all despite the higher rents. So despite higher numerator, the occupancy cost still remains low, mainly because of the tenant sales performance is still doing quite decent. Yeah, so tenant sales in FY25 was up 3.7%. Shopper traffic was up 1.5%. Yeah, so going forward, things like the government support measures will likely help with the tenant sales. And another positive is that the lower cost of debt. So it quarter on quarter, it was down 20 basis points. So now it's at 3.5%. So this is down from the peak at 4% back in first quarter 2025. So going forward, we probably expect the FY 2026 interest cost to drop further. So likely around 3.3%. Yeah, so their leverage also improved after they issued the perps. So they issued the 200 million perps recently. So the leverage is now below 40%. And they also, for the full year valuations, they reported a slight increase. So it's a positive 1.3% like-for-like increase in valuations. So excluding the North Point City South Wing acquisition as well as the Yishun 10 divestment, of course. Yeah, so for the negatives, they had a lower portfolio occupancy in the fourth quarter. So in the third quarter, it was 99.9%. In the fourth quarter, it was 98.1%. That's because of the exit of Cathay Cineplex. So that's a distressed cinema operator. So if you exclude the exit of Cathay, the portfolio occupancy would have been 99.9% or so. So it's a stable year on year, stable quarter on quarter. I mean, yeah. So Cathay exited both Causeway Point as well as Century Square. So both malls now have an occupancy of around 92%. So we do expect some downtime for the spaces vacated by Cathay. As FCT, they are trying to evaluate their options, like whether they relet to another cinema operator or perhaps reposition the space, break it into smaller spaces or such. So this might take some time. So we do expect at least another few quarters of downtime for this space at Century Square and Causeway Point. Yeah, so other than that, for the outlook, right now, Hougang Mall is undergoing AEI. So the first phase is already complete and it is expected to begin operations from November 2025. So other than that, the overall AEI of Hougang Mall is already 80% pre-committed. So they have 30 new to Hougang concepts as well. And for the potential for higher rent reversions, we think it's still good because other than the fact that occupancy is low, like I mentioned, there is a limited new retail supply also incoming until 2028. So from now to 2028, the stock is it's 2.4% is a typo, not 24%. Yeah, so 2.4% of current stock. So it's very limited. Yeah, and the tenants will continue to benefit from the government support measures. Yeah, so no change in our call. We maintain accumulate. but we raised our target price to $2.74 as we roll over our forecast and have a lower risk-free rate assumption as well. Yep. So FCT is trading at a 5.2% dividend yield. Yeah, next slide, please. Yeah, so for Keppel DC REIT, the title is DPU DPU growth despite the preferential offering. Yeah, so that's really the story for them. Their potential to drive DPU growth is really very strong, especially from the positive rent reversion, like 50% we saw in the second quarter. Yeah, but for the third quarter update was in line with our estimates. The DPU year on year is up 1.4%. That is even after the preferential offering. So if you because the preferential offering which listed on 22nd October is entitled to the distributable income from 1st July, so entitled to the third quarter DI. So as a result, the DPU was lower. If you exclude, or rather, if the preferential offering did not happen, the year-on-year DPU growth would have been about 10%. Yeah, so the revenue also it grew mainly from the contribution of the SGP 7 and 8, which we acquired end of last year, as well as Tokyo Data Center 1, as well as the higher rent reversions and base escalations as such, slightly offset by some divestments. Yeah, for the positives, despite no major contract renewals in Singapore, so that is the one that the co-location contract, major contract renewals are the ones that can get like 40% rental reversion. Third quarter, the rental reversion was at 10%, which is still very strong. So that is like the normal, like the market growth rate, like for high single digit to low double digit for other geographies. And for that, they have for the rest of the year, they have 1.7% of leases due to expire. So for this 1.7% or so, there's no major contract renewals in Singapore. So we're expecting similar, like high single digit to low double digit positive rent reversion from this 1.7% of leases. And for finance costs, they also experience some lower finance costs. So the cost of debt also declined. So over the past 3 or so quarters, every quarter it was down 10 basis points. So now it's at 2.9%. And right now 74% of their debt is hedged. Yeah, so for their foreign source income, because a lot of their debt is a lot of their income, or rather they have a lot of business overseas, like 31%. So it is substantially hedged until end 2026. And right now their gearing is at 29.8%. So that's very healthy, below 30%. But after they complete the acquisition of Tokyo Data Center, which we expect, Tokyo Data Center 3, which we expect by the end of this year, the gearing we expected to rise to about 34%. Yeah, so for the negatives, it has been quite a while, almost 2 years. Yeah, there's no improvement in at the quantum data centers. So Keppel DC, they continue to provide for the loss allowance and for the income. So right now, Blue Sea, which is the tenant at quantum data centers, they owe over 45 million in rent to date. Yeah. Yeah, so for the outlook, basically, demand drivers are still very favorable for Keppel DC REIT, like especially from adoption of AI, growth in cloud computing, and digitalization. Yeah, and Keppel DC, after they've acquired so many things over the past year or so, and a lot of portfolio transactions, they're still looking at third-party acquisitions in established data center hubs like Japan, South Korea, and Europe. And yeah, there will be an AI at SGP 8. So that is to convert half of a floor into a data hall. So that's about 13,000 square foot dimension. Yeah, and that will, once it's complete, likely at the end of 2026, it will be an uplift to some earnings. So that is for the organic growth part, as well as they also completed a land lease extension at SGP 1. Yeah, so that's about 10.7 million. Yeah, so with that, we maintain our neutral call. Our target price is higher from 2.33 to $2.40. That's mainly because we made some, or rather we accounted for the preferential offering, as well as the acquisition of the Tokyo Data Center 3. Yeah, and as a result, our target price rose. Yeah, but the forward dividend yield is quite low at 4.3%. So that is not so favorable for us because we think this 4.3% is too low, even though the fact that going forward the DPU growth potential for Keppel DC REIT is very high from the positive rent reversions. Yeah, but 4.3% for REIT, we think there are better players out there. So that's why we have a neutral call. Yep. Thanks. Moving on to the REIT monthly. Yeah, so the title is more to benefit from low interest rates. So far there are quite a few results already, and most of them have already benefited from year-on-year low interest rates. Some also even benefit from quarter-on-quarter low interest rates. Yeah, so for the share price performance, we see most of the REITs are up year to date. Yeah, so share price performance over the past 4 months or so, it really recovered over 10%. So that is attractive, and now it's already year to date, it's up 9.2%. Yeah. Next slide, please. Yeah, so this is the 10-year dividend yield spread. So basically, this means this chart shows how much you are being compensated for investing in REITs, like the forward dividend yield minus the 10-year Singapore government savings bond or 10-year MAS bond. So that is so-called the risk-free rate proxy or fixed deposit rate. So what we like to see is this chart keep going up. It means investing in REITs is more favorable as compared to investing in the risk-free rate. Like the risk rewards is favorable. So it's risen from 2022. And going forward, we expect this to continue to improve as the absolute number of DPU. We expect it to continue to improve from low interest rates, as well as the fact that with more rate cuts, the 10-year yield or MAS bond yield will likely keep declining. Yeah, we've seen in the chart here, 10-year yield, it rose, even though it rose slightly 8 basis point amount of money, it's 84% basis point lower year on year. The 3-month SORA continues to fall, so it fell 15 basis points per month. Yet year on year is almost over 200 basis points lower. Yeah. Next slide, please. Yeah, so this is a forward dividend yield chart. So it's down mainly because of the fact that the share price really rallied for the past 4 quarters, past 4 months. But going forward, we expect as DPU starts to improve, and assuming share price remains constant, the forward dividend yield will improve from these levels. And price to NAV is even though share price really recovered quite a bit, it's still trading below the price to NAV of historical price to NAV of about 1.03 times. Yeah, so we think the prospects are good and it's still attractive at these levels. Yeah, next slide, please. Yeah, so we move on to some of the subsector indicators. Yeah, so first of all, retail sales index looks strong, 4.6% up year on year. Tenant sales also, some of the REITs reported still quite resilient, especially for essential services. Yeah, and going forward, we think the potential for positive rent reversion is high for the retail subsector, especially since there is limited new incoming supply, like I mentioned during the outlook portion of FCT, as well as the fact that occupancy cost is still relatively low for most REITs. Some of the REITs occupancy cost has already reached historical averages, but we still think there is room for growth for retail subsector. So we still favor the retail subsector. Yeah, next slide, please. Yeah, next, for hospitality, we saw visitor arrivals, it dipped 1.3% year on year. That's mainly because of the fact that F1, the Grand Prix, was held in September 2024 compared to October in 2025. And for the Grand Prix itself, for F1, historically about 150,000, including this year, 150,000 foreign visitors. So if you add, if you strip that 150,000 visitors out of that visitor arrivals you see in September is actually year on year is up. Yeah, so we're expecting the October visitor arrivals to be quite strong because of the Golden Week, as well as the fact that of course F1 was in October this year. And yeah, we're expecting the full year hotel RevPAR also, which is the occupancy times average room rate, to at least be in the low single digits going forward after the first quarter, which saw some very year-on-year decline in RevPAR because of the very strong base in 2024 from the Taylor Swift and Coldplay concerts. Yeah, next slide, please. Yeah, so this is our coverage before the third quarter results. Yep, so that's all for me. I'll hand over time on to Zane. Thanks.
Thanks, Darren. Good morning, everyone. I'll move on to the technicals. So first slide on the S&P 500. Last week, there was positive price action. On a weekly basis, the index was up 1.9%. And then on Wednesday, when the price actually retested some of the short-term moving averages like the 5-10 MAs at 6,690, held as support before breaking out of this range between 6,555 to 6,764 on Friday to form a new all-time high. So overall, we see the index likely to trend higher to actually possibly retest this trendline resistance that could pose as the next short-term resistance level. So that is likely to be at 6,880 to about 6,915 area. And then current support is likely to be at 6,700 to about 6,765, which was the consolidation area last week. Next slide. And then in terms of the summary of our trades initiated last week, we had a technical buy call on AMD. So currently it's up 4.4%. Yeah, that's all from me. I'll have a time to Paul for the Singapore Weekly. Thanks.
Yeah, thanks, Zane. So I will just run through some of the macro highlights. So for Singapore, some of the main macro highlights was a lot on property. I'll just give you a bit of snapshot. So for the residential property price, it was up about 5%. I think we have to be very careful with property price. We don't need to overheat, but so far it's still below the double digit. But it's still the fastest in 5 quarters. Property transactions is just spiked up. It's tripled. I mean, yeah, almost tripled by 183%. So it's good for PropNext. And the volumes are trending towards the 3,000 plus per unit since 4th quarter. So on a year-on-year basis, you should start to see things normalize by next quarter. So next quarter, you won't see such like huge year-on-year jump. It should probably stabilize, maybe high single digit kind of growth levels. Industrial production was still very strong. So we're beginning to see manufacturing coming back very strongly in Singapore, at least for September. I think this was all over the news. I think the CPI, the core CPI, which was 3%, it is just slightly below market expectations. But the market still rallied on that news because they think that because the Fed will be expected to cut rates. Anyway, let's move on to the next slide. So in terms of tactical views, the highlight that we, of course, several major key events, but one of the main ones is, of course, the FOMC meeting on the 29th, where they will make an interest rate decision. Market is now pricing 100% certainty of 2 rate cuts. Sorry, it's not November, it's October and also 10th of December. So it's already a done deal. I guess the market's expecting 2 rate cuts coming. Again, because of the weaker than expected inflations. So for us, technically, if you over the next 12 months, we are looking at least 4 rate cuts coming up by the Fed. This will be so we think this will be very positive. You should expect a melt up a very vibrant market for this week because of the Trump meeting too. But anyway, for REITs, we think that if dividends were to start to grow again, because the last 2 years dividend has been sluggish, either flat or down. But I think moving forward, the next 1 to 2 years, especially with interest rates in Singapore collapsing, that we should expect dividends to grow back again for REITs, and this should help provide a re-rating for REITs. In terms of where the market is expecting rates, so market is now expecting rates to be cut by the Fed to around the 3%, where they deem it as the so-called neutral rate. So neutral rate is just a fancy way to say equilibrium. So market expects rates to come down to around 3%, where it's neither too tight or too loose. So the next big meeting is, of course, the Trump meeting on the 30th. We, of course, have no idea what could happen. This is our base case guess. We think there will be a temporary truce, and of course, he won't meet until things are resolved. So far, everything looks good. We should expect some truce, maybe lowering of import duties, soybean purchase. China will extend their rare earth ban. Yeah. So anyway, there should be some good news too there. And if you look at Malaysia, actually, even though the headlines, there's a lot of tariffs, but there's a lot of exemptions. So almost 60% of all the exports that come out from Malaysia to US actually all exempted. So we are beginning to see a lot of exemptions, not just for Malaysia, many countries like Japan and so forth. I don't have a list, but there's so many exemptions that the real actual impact on tariffs is actually much lower than the headlines. Back to Singapore residential market, we think that there is a bit of a balanced Goldilocks. That means which is not too hot that the authorities will intervene. So volumes are vibrant. The price gains are still below the double-digit increase, which usually historically once property price rise to close to 10%, you will see the authorities start to come in with cooling measures. The logic here is that although it's only 10%, but if this continues over 5 years, then property price of 50%. So that is deemed unsustainable. But the property metrics, we show a chart later, is actually very positive. So inventory, that means unsold property or property units going to be launched is about only 1.5 years compared to 2.7 years. So you should expect some aggressive bidding by developers. The one way to play, of course, CDL. So CDL over the weekend launched Zion Grand, 3,100 per square foot at Havelock. So Havelock is also like the new Orchard, I guess, property price. Okay, anyway, some of the key things to watch for is FOMC meeting, the decision, then of course the Max 7 results and so forth. These are some of the events that we are hosting, open to anyone. Next slide. So just a few more slides before we end it. This is just the property price. I know it's hard to see, but if you look at this pre-cooling rally, 10.6%, sorry, it's a bit small. Then there's a cooling measure coming up. Then 11% rise in the property market. Then again, another ABS was hit. So whenever you hit 10%, 11% rise, that's where cooling measures come in hard. This is just to show the spike in new home sales. Yeah. Next slide. So on this slide, it's just to show the inventory, which is the red line. So what I do is take the unsold inventory, whether yet to be launched or already launched. Then you just divide by sales by the last 12 months. So inventory is very lean. So developers have to replenish inventory. So you should see some aggressive bidding for GLS, government land sales, which will again push up property price again. And one thing good is that the speculation, which is sub-sales, is actually coming down. So that at least there is one thing that is not overheating the market. That means sub-sales means you sell the property before completion, before TOP. So as a percentage of total units, it's coming down quite sharply. Next slide. Okay, so this is basically where the market is expecting for rate cuts. So you're looking at 2 rate cuts in October and December. Another 2 or 3 more cuts in 2026 before it stabilizes. So the market is plateauing at about 3%. So if you just look at the red line, which is where inflation was, the Fed's favorite gauge. So inflation at 3%, the last time it was 3%, if you look at 2021, interest rates was basically 0. So it's justifiable that the Fed can cut rates. I mean, the last time it was 3%, actually, of course, they actually raised rates at that time. Inflation was creeping up very strongly. Then just one last slide to show you where things are slowing down. So goods inflation is picking up, the green line. Energy is also rising, but the core things, which is services and shelter or rent, the black line, the orange, the yellow line, all these are trending down, although not very fast, but they are trending down, and that's helping suppress inflation in the US. Next slide. I think that should be the end. Yep. Okay, I think that should be okay. Thanks everyone. Thanks. We can move on to question and answers. Thank you.
Hey, thanks, Paul. Let me take some first before I'll just take a few, and then the rest I will try to type the answer out because we really have quite a few. So yeah, I think there's 2 questions on CASA, if I'm not wrong. Yeah, hold on, let me just try to find. Yeah, so the first one is asking why would CASA be rising when interest rates are expected to fall with Fed rate cuts? And also, there's another related one from Ian here asking is, again, why interest rates falling? Why is CASA holding up at Singapore banks? What is the driver? And do we expect CASA to drop going forward since perhaps better to park money in Singapore bank stocks which give like 5% dividends versus saving in the savings fixed deposits with meager yield. Yeah, that's a very good way to look at it. But then again, you must understand that this money that is parked in the CASA, we believe came from fixed deposits, right? And this I know, although you put it in the Singapore bank stocks, but there's always the risk, right? You're doing in equities, and I guess a lot of these consumers, this is my best guess, people who need the cash, right? Who have cash and maybe they already have quite a portion into equities, but they also have a sum that they need, in case they need liquid cash, right? So they put in fixed deposits and they put it into CASA because this can be withdrawn immediately and it's guaranteed, right? The capital is guaranteed. Whereas if you put it into stock, right, any stock, right, there is no guarantee, right? There's always a fluctuation in volatility, even with the bank stocks, which are quite stable. So that's probably the reason why it's being placed into CASA, and the main reason why it's still holding up and why it's actually not just held up but increased is because of the drop in interest rates. And then fixed deposits, and not just fixed deposits. You look at all those very, very extremely low risk investments, like fixed deposits. You're looking at your the government securities or the bonds, Singapore ones at least, right? They have all, the interest rates have gone from like 4+%, you could get it easily last time, to now like 1%, 1 and a bit, maybe below 2% if you're lucky. So and it's not just the local banks or the government, the bonds that are being affected, right? You look at the digital banks as well, right? They're all slashing their interest rates like crazy for their current accounts, their savings accounts, as they call it. Yeah, so a lot of them are now just putting into CASA, holding it there, just in case they need it. And a lot of people are, they're maxing out their maximum, I guess, if you have the cash, you're maxing out that the maximum cap, right? That a lot of these current accounts offer. Look at multiplier, I think it's max at like 50K, and then UOB one account is at 100K. So they will just put it in all this and just mix it up. Yeah, so that's the reason why it's holding up. So maybe previously they didn't max it out. It was like maybe like 20K, maybe 30-40%. And now instead of putting the fixed deposit, they say, oh, since I got this balance or this leftover, I'll just put it back there to hit the cap. Right, and that's why we believe that the CASA has been steadily increasing. Yeah. So just to answer, multifaceted question, that's the reason why, and we believe that it will still hold up because fixed deposit interest rates are just going to continuously decline, and we are seeing it decline. Yeah, and also like what I said, the money they need to be liquid. That's the reason why they put it into, previously they put it into FD, now they just place it back into CASA. One more on the Singapore ones, Singapore banks. I think there's a question here that is asking, sorry, where is it? Asking whether or not, looking at the, hold on, yeah, from the perspective of the PB perspective for Singapore banks, it looks like UOB and OCBC are trading below historical PB and better to accumulate versus DBS. Yeah, so between OCBC and UOB, which is the better pick, I think. Yeah, a better buy. Yeah, so very good observation there. Yes, it is. And I guess the reason why, the average PB has been pushed up higher is because of DBS. And so DBS's PB went up and then the average also got pulled out along with it. But UOB and OCBC are quite stagnant. So that's the main reason. If you're comparing both OCBC and UOB, I would say UOB has a bit better, I guess, the forward looking, the potential is slightly better because it's a clearer path, right? They have been pushing for this ASEAN growth for the last 3 years, right? And they also have these huge city assets that they had acquired, and now it's like fully folded into the company. Yeah, so it's a clearer path to doing that, to growing. Look at OCBC, they don't disclose much, they don't say much, and also they just change the CEO. Right, so they are a bit of, they're saying that their strategy is still the same, right? They are one OCBC group, right? But then again, if you change in CEO, right, a change of, they're probably going to change up some things as well, right? This will take some time to get effect. So I guess if you want more stability and a better, clearer path for growth, UOB. If you compare both of their dividend policies, very similar, right? OCBC's dividend policy is actually not as clear, right? They're only giving guidance until the end of this year. we're not very sure what they're going to say for 2026 or 2027. At least you get it until 2026. There's a bit more clarity. Yeah. And then both PBs are also quite similar. Yeah. And maybe I'll take one more question before I hand it over to the rest of my colleagues. Yeah, I was asking about the Bank of America being affected by consumer. Yeah, so Bank of America is negative. It's actually weakening consumer. Sorry, the negative for Bank of America is actually weakening consumer spending. No, yeah. So I would say not just Bank of America, but Wells Fargo. They are both very heavy US domestic players, right? And yes, it will affect weakening consumer spending will definitely affect, right? It will affect both wealth management, it will affect their credit card as well. So I guess both of them will get affected. But then again, what we are seeing recently is not it's not so much on the consumer spending has not really weakened, but it's weakened slightly, but they are pivoting to other ways, such as they're going towards their investment and brokerage arms to try to offset some of that decline. And we're also still seeing strong growth in their consumer segments as well for both Bank of America and Wells Fargo. Yeah, I think that's all for me. The rest I will just have to type it in because the lack of time. I'll give the rest of my colleagues. Yeah. I'll hand over to the rest of my colleagues. Thanks.
Thanks, Glenn. I'll take on some questions. Sorry, skip. Is NVIDIA's dominance being challenged by AMD amid a slew of deals recently? I think there's a bit of risk, but I don't think it'll be challenged significantly because NVIDIA still has their CUDA software ecosystem, which has helped it to maintain the market share 90% over the past 2 years, even with AMD's very strong hardware as compared to NVIDIA. But NVIDIA is still able to maintain this kind of market share because of their software ecosystem, because it is market standard, and most of the developers are still using CUDA ecosystem. So there's a lot of troubleshooting. There's a lot of help being provided within the software ecosystem, which the developers can benefit from. Yeah, so I do think that they are still able to protect their market share. Yeah, next one. What's your take on IBM using AMD chips to run quantum computing error correction algorithm? Yeah, so I think with regards to the tech, specifically to quantum computing, I'm not very familiar, but I do think that it will still take many years out. It is still in a very early phase. Even NVIDIA CEO mentioned at the start of this year that the use case will be 20 years out in the future. But of course, he came back and corrected it. But that's the kind of time frame. I think it will take at least like 4 to 5 years before it will run commercially. But I think the takeaway from this is that AMD has been still securing more deals ever since the OpenAI deal. Like, for example, Oracle has been signing a deal with AMD, and then now it's IBM. So their chips is very competitive compared to NVIDIA. Their most recent hardware, their MI355 chip is comparable in terms of inference performance and 1.6 times more powerful in terms of memory performance compared to NVIDIA's Blackwell. Yeah, so I think that's the takeaway I can get from this. How will ASML results impact Franken? I think there will be a slight indirect impact because I think indirectly it will flow through to Franken's results. But however, Franken is supplying a key component to ASML's high-NA capacity. So ASML is trying to build up this high-NA EUV technology, which Franken supply the key component. So right now we are still not seeing the sales from high-NA, this equipment itself, because ASML is experimenting on it, and it still takes about 2 to 3 years to really build out this equipment itself. So in the meantime, we do think that Franken will still benefit because ASML's capex will flow to Franken as they experiment on this new technology. And we also think that Franken will also benefit from ASML's expansion into Asia operations. Yeah, so I personally don't think that Franken will be impacted that much. Yeah. Any takeaways from Intel results? Is the return to profitability sustainable? I think the takeaway is that Intel has a stronger balance sheet now. They receive about total $20 billion cash. Some from US government, 2 billion from SoftBank, 4 billion from the sale of Alteria, their loss-making business segment. However, so their balance sheet is stronger, but however, for it to be sustainable, we do have to see whether they are able to gain back market share in terms of their PC segment as well as their CPU segment, because with the deal with NVIDIA, if it will definitely strengthen their competitiveness, because Intel will be supplying NVIDIA their CPU chips to be built into NVIDIA's Vera Rubin the infrastructure itself. Yeah, so this will increase the competitiveness of Intel. So we do have to see how sustainable it is. But I think for next quarter, they'll still do well because they have finished their cost-cutting efforts. They have laid off their employees and they have sold off their loss-making businesses. So I think very near term, next quarter itself, their results will be good. Yeah. AMD views on the fundamental. Yeah, I think I touched on AMD a bit. I'll leave the TA portion to Zain. How will Alibaba affect NVIDIA if their chips business take off? NVIDIA was $186. Any adjustment to TP of 185? Yeah, Alibaba is, for context, they're also having their own chip segment, chips designing segment. But I don't think it will really affect NVIDIA if their chips business take off, because NVIDIA in the most recent quarter, the percentage of China revenue to NVIDIA is only about 6%. And they have been reducing their reliance on China over the past 3 years. 3 years ago, it was 26%. So yeah, so I think NVIDIA's growth driver will still mainly come from sovereign demand. For example, as mentioned, from EU, from also US increasing the emphasis on AI. Yeah, so I don't think that even if Alibaba take off, it will impact NVIDIA that much. Because NVIDIA's most recent quarter, their revenue grew by 54% year-on-year, despite their China revenue being only about 6%. Yeah. Any adjustment to TP wise? For now, no. We will still look at their next quarter's earnings. But I think highly likely we will do an adjustment based on next earnings results. Yeah. Is Micro Mechanics expected to report good results? Seems like a value play compared to other tech stocks in the SGX. Yeah, I personally believe that I think they will report good results because they have manufacturing capabilities in the US itself. And for their wafer fab equipment segment, they have been diversifying there. It makes up currently about 15 to 20% of their revenue. And for their latest quarter itself, it has managed to grow about 35% year-on-year. So that's a very strong performance in their wafer fab equipment segment. And this is because they are able to onboard customers from US itself. And they are also saying they are seeing more customers going to them because of the US policies in terms of increasing manufacturing onshore domestically. So I do think that they are expected to report good results. In terms of value play, they are currently trading about 20 times PE compared to tech stocks in the SGX. The average is about 28 to 30 times. Yeah, so I do think it's a value play. Yeah. Any news that caused Central Accommodation REIT share price to suddenly drop today? There's no news. I have been trying to search for it. I think it's just a bit of profit taking. Yeah. Yeah. For now, I'll pass my time to my other colleagues. Thanks.
Sorry, I think I'll answer some of the questions. 1 second. Yeah, there's one question. With the imposed euro 2.9 billion euro fine by EU Commission on Google, can you share what will be the impact on Alphabet? Yeah. So let's say that the decision actually came in on the fine only on short-term basis. Definitely, it will affect Google's legal cost related expenses. But I think since the company is pretty cash rich, I don't think that it is going to be a very immediate financial burden on a short-term basis. But then let's say that it involves certain level of remedies, Alphabet might be actually requested to share the auction data sharing with their competitors to promote the competition, or the worst case scenario that may be the divestment of the business. So this is why we think that the regulatory risk still remains in this edtech related case. The next one. Hi Serena, what's your preview of Alphabet and Meta earning this week? Yep. So for both company, I think it will be focusing a lot on the user engagement, as in like how users are still using their product offering. So for example, if it's for Alphabet, I think I will be interested to see the queries number, because there are a lot of Gemini integration into search products going on. And then for the advertising business wise, I think when it comes to key metrics, I'll be looking at costs, let's say like cost per click, if they can maintain maybe between 4 to 6%. If yes, then means like the monetization still pretty strong. And for Alphabet, definitely we'll see the cloud revenue growth to see that whether, because they do announce a lot of deals, so we see that how big is the client base they have, and also how much backlog they currently have. So they also might provide some of the info about the capacity. And for Meta, I think for Meta is also it's also metrics based. It sees that whether the average ad pricing continue to grow, and also how well they actually monetize the user by looking at maybe the average revenue per user to actually shows their capabilities. And also the user engagement maybe is like, the user actually spending more time on the ads? Yeah. Hope that answered the questions. What else? Sorry, this keep jumping. Oh yeah. Okay, this one question is about what is the impact of Google deal with Anthropic. I think the deal is pretty straightforward. I mean, this partnership definitely will help to boost Google Corp business. And currently there are still a lot of demands from enterprises. So I think for me it's really straightforward. So I think moving forward they still will be more deals like this. Yeah. Keep jumping. Okay, there's another question about what's the threat of ChatGPT at last to Google Chrome. Yeah, so one of the threats that might be at last actually might divert people away from Chrome browser, so that they actually will be less reliance on Google search. But I think the entire competition currently is actually running on a very long-term basis. I mean, short-term wise, I still believe Chrome actually has some edge, because first one is because the massive user and they are still very sticky within the ecosystem, and at the same time at last actually is currently building on Chromium. This is actually a open source web browser started by Google as well. So for multiple browsers, they actually have to use the base code, so that I think Google still retains some of the technical leverage. And the lastly, I think that we are still confident about Alphabet because they are not stopping on this AI integration thing. I think they keep having improvement in AI integration to keep up with the competition. And currently, we are still seeing very strong monetization from the company for their ad business, but less so on the plan on the monetization from OpenAI in this area. So that but I think if they did announce it eventually, we still think that the data access and also the data owning of Alphabet will still keep them quite competitive. Okay. There's a question. Meta is cutting job in super intelligent department. What are the possible development? I think the cutting job decision is not because the company is pulling back on the teams or also vision. I think according to the memo they release it is more on focusing on smaller, more talented base teams so that they can streamline the process to improve efficiency and decision making. I think currently they're actually hiring more staff for the team, but maybe the role will be more on technical, like even more technical base. I think that's pretty much the questions. Oh, there's another question, sorry. Will Meta face competition from Alibaba smart glasses? At the moment, I don't think so, because these two companies, they are actually operating in a very different market. For example, like geographically basis. I mean, because the AI glasses are not really allowed in China. So, but then Alibaba's smart glasses are actually focusing on this market. And secondly, they're actually running on a very different ecosystem and also from very different purposes. For example, like Meta actually integrated with social media platform ecosystem that also is more on the social leisure base. Yeah, well, I think Alibaba is more on the enterprises side slightly. Yeah, I hope that answered the questions. I think that's all for the questions for me. I think I'll pass the time to my colleagues for other questions. Thanks very much.
Yeah, thanks, Arina. Let me try to answer some. MLT, the question jump again. MLT REIT is a China issue a past event. Yeah, outlook please. Yeah, so for MLT, after many quarters of like low double-digit rent reversions, we think the rents are likely to almost bottom out already. So we think because a lot of the leases have already been repriced to kind of market, which is at a lower rate already. So once the leases have been repriced to market, we think going forward it is likely that possibly by next year, the rent reversions will start to be less negative and even possibly be flattish to zero as basically the rents have already repriced lower to market. So yeah, going forward, we think the China issue likely could see a recovery possibly in next year, but not so we won't expect very strong positive rent reversions, probably just slightly flattish as the rents have already been repriced. Yeah. So in the past, over the past few quarters, they kind of prioritize occupancy over rents, meaning that you rather have the property filled with lower rents than have the asset vacant. So as a result, they had that lower double-digit negative rent reversion. But going forward with this improving conditions and market rents that are already at market, so we think they likely can keep their occupancy in China around 93-94% for the full year. Yeah, so that is quite a good recovery in our view. Yeah, so that's for MLT. What's your view on recovery period on Prime US REIT since you're positive on the REIT sector coming forward? Yeah, so for Prime US REIT, we're also positive, but we know there are some risks involved. Like, because it's for Prime US REIT, a lot of it is kind of a capital gain story also, because right now it's traded at a price to NAV of about 0.4 times. So huge discount to NAV, as well as the fact that going forward, as they start to distribute their dividends. So in the second half, they already indicated that they will pay 50% of the dividends, 50% of payout, 50% payout ratio. So this is much earlier than the other two US REITs which have not started or not resumed the dividends as of yet. So just a reminder, Prime US REIT, they never stopped paying dividends, so they just lowered their payout ratio to 10% over the past few quarters. Yeah, so going forward, we think that the market is still underpricing the fact that there is a lot of income visibility for prime, especially with a lot of cash contributions from the large leases that have been signed yet to begin contributions. So going forward next year, all this income will start to kick in, and as a result, the distributable income will increase. So currently, about only 70% of the portfolio is contributing cash. So the portfolio occupancy is about low 80s, 81%. Yeah, so we think once the cash flow starts flowing in, then there will likely be a repricing of prime US REITs. Yeah, so we think yeah, from capital gain perspective, it is the risk rewards are promising for prime US REIT. Yeah, I mean, of course, this is complementing the fact that the interest rates continue to get cut, and yeah, they'll benefit from that as well, as along with a lot of other REITs. What's the outlook for some of the upcoming REIT results? Yeah, CICT, MLT, Mintescott. Yeah, so basically the outlook is lower interest rates, like lower finance costs as well. Like we've seen that happen for so many of the REITs that already released results. Yeah, even though the initial guidance was some of the REITs perhaps they guided like flattish interest rates, but even those REITs, they even saw some decline as well, as the 3-month SORA really fell so much. Yeah, so fell like over 200 basis points year on year. So yeah, that will really benefit a lot of these REITs. So yeah, upcoming, all those with Singapore exposure, Singapore loans definitely will benefit from that as well. Lower hedging, lower debt on fixed rate. So those REITs will benefit the most. Yeah, I think I'll just answer this for now. I'll type in rest of questions to give rest of my colleagues a chance to answer, as well as Zane. Yeah, thanks.
Yeah, okay. Let me answer this since this stock move up so much. Why is IX Biopharma rally so much? Yeah, okay. So IX Biopharma, the share price is up, I think 6 times or 7 times the last 1 month. Let me just give you a bit long-winded answer, but some may not know what they actually do. So for IX Biopharma, they actually have this technology where you put an active ingredient. I'm just using example. Maybe you like Panadol, the active ingredient is paracetamol. So you use the active ingredient, then rather than swallowing it, where you know the stomach may not be able to absorb all this active ingredient. The technology is to put it under the tongue, and then it will just get absorbed into the bloodstream immediately. So we did cover this up to 2022 because one of their main customers, Celos, kind of defaulted on their licensing agreement. So that's why the share price collapsed. So recently the share price has rebounded, and I'm not sure, but if you look at the AGM slides, so the issue for them is always about commercializing the technology. So they actually, on the slides, they said they're targeting compound pharmaceutical. So compound pharmaceutical is a way to kind of sell your drug without going through a heavy US FDA route or route, where they actually, their drug Wafamine, which is using ketamine, actually already past phase 2. So what, according to the slides, they said that they are going to set up a joint venture. They don't have to come out capital, and this partner will help manufacture the drugs. So it's one way to commercialize their technology, where they go through this compound pharmaceutical. So long as the active ingredient is already approved by FDA, not like paracetamol is approved, you can actually kind of prescribe it to patients. So this is a him. If you in the US, is very popular. This company called Hims and Hers. So Hims and Hers is listed. So it's a way to compound. It's a bit unique. In Singapore, we may not fully know this, because compounding is a way to deliver, because some medicines are in shortage, and then the doctors want to prescribe. But the other thing that in his slides was, they said that they could get, they're working with a US government agency. I'm not sure who it is, but a US government agency where their key product, Wafamine, they might try to get it approved by FDA. So we're not sure how this is done, but of course, we don't think IX has the financial capacity to fund the phase 3 trial. But if this US agency can help fund the phase 3 trial, then of course, that will be the bonanza for them, because they've always been trying to get phase 3 approved, and means get US FDA approval for the wafer mean, where you use ketamine as for painkiller for depression and so forth. So that's generally what I read through from the slides. So that might be the what's causing the share price to rally so hard. I think the last 1 month, I think. Yeah. I think we still got lots of slides, but I think we'll leave it for. We'll try and type out some of them. And then we will leave it to Zane to take on some of the. Yeah. Zane, over to you. Thanks.
Okay, thanks, Paul. I'll move on to the TA first. Let me just share my screen right now. The first one I'll take SIA. Yeah, so for SIA, I think it's still pretty much quite range bound for now. Still seeing quite a bit of resistance of 665 around there. And however, on a weekly basis, it's looking a bit better, but it's a bit slow. So on a weekly basis, price is currently above the 5 and 10 MAs on the weekly, which is around like 660 about the area. And then currently there's some resistance around 20 MA weekly, which is like 665. So I think really need to see price try to break out this area, then we might see price go up a bit. I think might be a bit slow. Then the next resistance may be a bit like 674, which is a recent high, and then around 683, which is previously this opening price of a gap down. So for now, maybe it's just quite sideways, then see whether it can form a bit of a higher low around 658 around here. Yeah. Then next one is on CapitaLand China Trust. Yeah, so for CapitaLand China Trust, I think it's in an uptrend right now. The key support to hold will be at like 77 cents, which is this previous resistance holding as support a few times and trending along this upward support line. So I think for now, some resistance maybe around 81.5 cents this swing high. But if as long as price can hold along this trend line support, I think possibly we could see the uptrend continue on afterwards. Yeah. And next question is on SRT, which is a CSOP IHS REIT Leaders Index. So for this, has been on a very steady uptrend, and recently, the chart developments has also continued to show positive signs, which will break out this 79 cents level after about a 1 month long sideways consolidation. So I think with that, we're likely to extend the uptrend for this REIT index towards the next. I think the next level is around close to 81 cents level previously, and then the next recent around 83 cents previously. Yeah, so I think we're likely to see the uptrend carry on. And next one is on First REIT. For First REIT, I think it's trending within this uptrend channel since quite long ago, like October 2023. So that's about 2 years ago. So just steadily moving higher. I think in terms of resistance wise, probably is around 29 cents to 30 cents area, where 30 cents was the previous horizontal resistance. And for now, maybe just a bit of a sideways with support around 27.5 cents about there. The next question is on Everglory. Yeah, so for Everglory, I think the chart is showing positive developments because it has actually broke out of this range consolidation between 65 cents to 70 cents recently, and then just consolidating sideways. And in terms of the short-term price action, is also holding above the 5 and 10 day averages around here, like about 69.5 cents to 70 cents area, which was like this breakout level. So you can hold over. If price can continue to hold over here, currently is on a bit lower volume compared to the breakout volume over here, then I think it's quite positive that price could do a retest of the 75 cents level. Yeah, on the weekly itself also has been continuing to hold above the 5 and 10 MAs on the weekly. So that's still a very good uptrend in terms of the mid to long term. And short-term price action is also looking better. Yeah, so I think there's a chance that price could go to retest the 75 cents level again. Then next one is on TeleChoice. Yeah, so for TeleChoice, I think today there's a gap up 19.1 cents, and currently it's about 18 cents. So I think it's good that price broke out of this range over here that it was like 16 cents to 17.5 cents. And if we can hold this level as this 17.5 cents level as support, I think that will be positive for price to possibly hit higher. The key resistance I think will be around somewhere around 19.5 cents to 19.8 cents, which was the highest between like June to August this year. Then overall, it's still in I would say probably still in a big range over here. So I think for now we'll see whether this the breakout of this resistance can hold as support. Then that could see whether price can go higher. The next one, 1347 is Hua Hong Semiconductor. So I think for this is a very strong, has been on a very strong uptrend, and recently looks like a bit of a sideways consolidation, I guess. And on the weekly chart, it did a retest of the 5 MA on the weekly after a very strong rally, and I think for now support wise would be around this around 82 Hong Kong dollars, which is the 5 MA currently. And then I'm expecting price to continue a bit of a sideways for now, with some resist to maybe retest on the resistance during the rally around $90 to about 99 this area. Then support wise might come from the short term movement ranges around here, as well as the closing on Friday around 80, maybe $82 about there. So maybe a bit sideways. Okay, next question is on Keppel DC REIT. I think for Keppel DC REIT, it has been on a steady uptrend. Recently a bit has been still maintaining in this range consolidation between $2.34 to about $2.43. I think afterwards you can break out this range, most likely we'll see an extension of the uptrend. I think overall it's been just trending upwards steadily since May this year, and key resistance it has been respecting will probably become from this trend line over here. So if it does break out afterwards, I think somewhere around 250 onwards, that will be the next resistance level. The next one is on the Lion OCBC Hang Seng Tech ETF HST. So for HST, I think recently there's been a bit of a rebound after this pullback towards the previous resistance level again, which is like around 93 cents over there, and then as well as this our support line. And currently there's a bit of a rebound. Yeah, so for now I think some short-term resistance on the weekly itself. Last week we claimed the 10 MA. So for now, some short-term resistance might come from $1.03, which is the horizontal level previously. And I think for now we might just see some sideways with some resistance, probably short-term resistance coming from the breakdown of this 103, 104 recently, and support is likely to be around 99 cents, the horizontal level over here. So I think maybe some sideways consolidation in the short term. And for ThaiBev, ThaiBev slowly inching up recently, but I think will be quite, there's still quite a lot of resistance from the past. Like, for example, for the 9.5 cents area, there's some resistance from a support breakdown, and then above that will be around 51.5 cents. So for now, maybe just still some sideways consolidation, perhaps. Yeah, but good thing is that recently managed to hold above 47.5 cents. Then I'm expecting a range between 48.5 cents to about 50 cents in the short term. Yeah, and there's a question on two ETFs, SCY and CXS. For these two, the volume is relatively low, so in terms of using technical analysis might not be as useful, but in terms of, I will try to explain in terms of the trend for the SCY, which is the CSI Chinex Index ETF. This one, it looks like a probably range bound in the short term after a strong rally and then some pullback recently and a bit of a rebound. So pullback towards the previous resistance like 120 about there, holding as support. And I think for now, short-term resistance likely to hold at 138. Then most probably see some sideways consolidation with near-term support. I would think it's around 127 about there. Then for CXS, for CSS, quite similar as well. This is the Chinex ETF as well. Also should be quite sideways in the short term resistance, possibly around 117, the recent high. And short term support might come around by 108 this area. So I'm expecting some sideways consolidation after this rally. And the next one is on oil tech. Yeah, oil tech has been pulling back quite a bit recently. Since the breakdown of a few levels like the 95 cents and then recently tested about 82 cents this swing low and doing a bit of rebound. I think the key to a recovery will be to see whether it can try to break out this downward resistance line over here and try to hold above the 10 MA level, which has been acting as quite a bit of resistance. So I think these two, if it can break over these two levels, then there could be a short-term rebound. In terms of the weekly wise, tested the 20 MA on weekly, then currently still below the 5 MA, like around 91.5 cents level. So that will be key to break above for a short-term rebound. Yeah, then 95 cents will likely be some short-term resistance. So I think for now, we could see maybe still a bit. I think this swing low will likely hold in the short term. Then maybe some sideways over here first. If I hold like 87 cents, 88 cents over here, a higher low, then there could be a chance to try to do a bit of a short-term recovery. For CSE Global, CSE Global, I think overall is still quite good price action. Recently, there was a recover above this breakdown actually quite fast at 71 cents, and following which tested resistance at 77 cents, and then Friday itself closed at the resistance and going higher. So I think with that, should be quite positive for price to continue the uptrend. Yeah, and then I think next level of resistance probably be around 81 cents to 84 cents next. Yeah, then overall the trend is trading within this uptrend channel itself in blue. For SIFMAC, also has been on a steady uptrend. Recently has been doing a bit of sideways consolidation since about one month ago, and that's between 106 to about 112. And I think probably we could see an uptrend continue on with a likely breakout today at around $1.12. Yeah, so I think with that, most likely could see the uptrend continue towards 118 as the next key. That could be a next possible resistance. So still maintaining the uptrend pretty well for SIFMAC. And then CNMC pulled back recently after a strong run. And I think some of the currently on the weekly wise, after a very strong rally, is below the 5 minute weekly. So currently 119 about there could be a bit of resistance, which is also a horizontal level breakdown. In terms of support, could look to maybe could look for a retest of the 10 MA on the weekly. Currently is about 103 about there. And 104 was last week's swing low. So I think there will hold as support for now first. And so I think for now, there could be a bit of a pullback to retest some of these supports, and then then maybe some sideways consolidation about that. Okay, I'll take one last one since it's close to 1 on iFast. So for iFast, I think after the earnings that we kept up today to test the swing high around this $9.83, I think over here, it might hold as a bit of a short-term resistance, but should be, I think I'm expecting higher highs to come, I think, given that overall it's been an uptrend and has been consolidating sideways before that. So overall, I think still on a very strong uptrend, and we could see, most likely we could see higher highs being formed afterwards again. Yeah, so I think there's still quite a lot of TA questions in the chats. Unable to take all of them, but feel free to just drop your questions in our Poems Tree community, then I'll answer it over there. Thanks. I'll hand over time back to maybe Paul, if you have any comments to add on. Thanks.
Yeah. Okay. Thanks everyone. Yeah, we got a lot of questions on this US inflation. So, but anyway, just a reminder, the US inflation, I think 1/4 of it is actually goods inflation. The rest is all shelter, that means rent and services. And of this 1/4, maybe 1/3 of it is impacted directly, indirectly by tariffs. So that's why the impact on inflation may not be as high as everyone thought, especially when you have so many exemptions coming up from the Trump administration. Yeah. Okay, with that, I'd like to thank everyone for your time and for all your questions. Apologies, we answered, I think, maybe 60 questions, but can't answer everything, but we try our best. Yeah, so thanks everyone for your time. Hope you have a great week ahead, and again, always thankful for everyone joining us. Bye-bye. Have a good week ahead. Bye-bye.